Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
All right, guys. In about 5 minutes, we will get the Fed meeting. I always have to put the disclaimer out there. You might see me put sim orders out here. Sometimes you might see me take small little trades on micro instruments. Please understand that the action that we're about to get in the markets will be extremely violent. People can lose their entire accounts in seconds. Please do not take risk on this if you don't know what you're doing and you don't have a real edge. So this is going to be some crazy stuff. And, I'm really not sure if it's going to be 50 basis points or 25 basis points. I think that the market may have successfully bullied the Fed into doing 50 basis points, to be honest with you. But I guess we're going to see what happens, right? Brad's like, oh, I'm throwing out 100 lot now because you said that. Well, I took some trades earlier. They didn't go well for me. The market seems to be coming back down to where things were. I don't know. That every once in a while, an opportunity will present itself, but I think that this is probably going to be too dangerous for me to touch. Plus, I got some stuff going on, so I will keep the stream going, but I'm not going to be able to sit with you guys through the press conference. So yeah. Wonder if I should just set it up on the laptop. Yeah, do it that way or something. Because otherwise, you won't be able to hear the press conference. Probably what I'm going to do. Actually, I know what I can say. Yeah. And then if I do something like if I want you to work. I think we'll be okay. For kicks and giggles, I'm gonna sell it in the sim order. I'll do 2. And if it's not 50, if I hear 25, then I'm cute. Oh, actually, that's not the trade that I want to make. Good that I want to be long into it, don't I? If I think it's going to be 50? Well, it's too late for me to do something now. Oh, no, I'm going to click it. Okay. I want to be long. Okay. Whew. Could have been bad. 50 basis point cut. Oh my gosh. Oh jeez. You know what though? I didn't get filled on my my first lot though. That's funny. Wowzer. Wow, look at those micros. That literally moved a whole handle instantly. Cause it didn't fill, but my first take profit would have been at, well, actually I didn't have the order out there, but if I had the order out there, it wouldn't have filled. Was at a handle. That's crazy. Well, this press conference is going to be interesting, right? Is the press conference going to be as dovish as the 50 basis point cut seems? Can you explain why you went long there? I'm not too big on the fundamentals. Okay, so my guess was that, so first of all, the market was, this is complicated because like there's this bit that's like, what was the market expecting and what were you expecting and all of these things. But the gist of it was this. I thought that it would be a 50 basis point cut instead of a 25 basis point cut. So I was thinking, okay, bigger cut means, bigger cut means treasuries go up more, essentially. Okay. Smaller cut, treasuries go down. Is basically what it means. The easier that monetary policy is, the more up treasuries tend to be. Wow, wait, it came all the way back? For real? For real? Should I trade that? Oh, look at that. The spread. There's no way I'm touching that. Are you kidding me? I guess if somebody wants to fill me at 685, but holy crap. Oh, I guess if this isn't a handle, this is half a handle, huh? Set yourself down. I got a little bit too excited there, okay? A little bit too excited there. So let me explain here, okay? You got interest rates and you got prices. Interest rates and prices tend to go opposite to each other, right? So if the Federal Reserve is reducing interest rates, that means that you should see these rates, these micro treasury yield futures, move down. And you should see the treasuries move up. Okay. So the market was kind of pricing in, or was kind of had priced that it was going to be 25, and then shifted in the last few days to 50 basis points. So my thinking was that the Federal Reserve kind of has to do 50 basis points lest it risk disappointing the market, was my thinking. So that's why I said I want to be long, holding the treasuries long going into the meeting, because I think it will be 50. Okay. It was correct. I wish that I had put my order out there, but it wouldn't have gotten filled. So it's pretty crazy that they pushed that far up and came all the way back. That's the sort of thing that you will often see, though, on these Federal Reserve days, and part of what makes this so dangerous to trade, right? So now that we've got that through, what do we have? Well, I still think that it's potentially a buy, but the chances of it coming back to 01 are pretty high, so be careful about it. Yeah, it didn't get filled by a tick. But so I didn't have time to go and put my take profit order before it happened. But I was planning on it being there for 1,000. If I had it there, it wouldn't have gotten filled. So it would have been unlucky anyways. But from that perspective, maybe it's not so unlucky, because for the exact reason that I put the order there is probably also the exact reason why it stopped where it did. right? Because I was like, half a handle is probably like the largest move that the market can probably handle at any one time. And that's exactly what happened, is they went right to half a handle and then got pulled all the way back. So that actually doesn't surprise me that much. That it was able to come all the way back to the entry location is a little wild to me. That's a little wild to me. Like, you will see big swings like that during Federal Reserve days and on non-farms and so forth, but that was still really jarring. Really wild and jarring. So well, now the problem is I don't know if I'm gonna get the full thing. So I think that I need to take one off at the 500. Okay. You can be stingy, huh? Tell you what, the market has not been friendly to me. There we go. Okay, so now if it were to come back down, I would pick another country. And I'll leave that open. Well, that was a huge monster order there at 09. Interesting. Is that a spoof? Is that a spoof to get somebody filled? And now it's gonna move. That was a really big one. Oh, now that's interesting, is that the Fed says inflation risks now higher. Not even a policy mistake, just a fundamentally easier Fed, says Eric Wallerstein. Legitimate dissent emerging from among FOMC members could lead to split votes in the coming months. Bowman dissented. Voting for the monetary policy were Powell, Williams, Barkin, Barr, Bostic, Cook, Daly, Hammock, Jefferson, Kugler, Waller. Voting against this action was Bowman, who preferred to lower the target range for the federal funds rate by 1/4 of a percentage point this week. Gotcha. So I didn't really get a, like the difference between the two of them. Let's see if we can find that. Let's see here. Job gains have, and they crossed out moderate and changed it to slowed. Inflation has made further progress. Committee has gained greater confidence that inflation is moving sustainably towards 2% and judges that the risks to achieving employment and inflation goals are roughly in balance. They've decided to lower the target range. In considering additional adjustments to the target range for the federal fund rate, the committee will carefully assess incoming data, the evolving outlook, and balance of risks. So they didn't actually change the statement that much, interestingly enough. I don't know. It's coming back there again, guys. I'll do it. I'll do one there. Come on. So, I'm honestly a little bit disconcerted by the action that we've had post announcement, because we did not get even close to the weekly high, right? And I feel like that fully pricing in a 50 basis point cut should be the highs. Once this Bank of Japan knew, oddly dovish sources the day your buddy pal is about to take stage. Also at odds with the public stance and hawkish BBG sources a few days ago, officials inside the bank are rolling out another rate hike move later this year in early 2025. I took sim trades. I'm still messing with this sim. Brannigan Barrett says this is an insurance cut from the Fed. They want to ease quickly at start-in case they are behind the curve. So they will cut fast at the start and then revert to every other meeting in 2025. Reality is market thinks otherwise. Market expected Powell to cut to neutral by the end of 2025. Powell will likely temper these expectations in the QA. Okay, so that's, I think, a good example of why we might not need to be careful here, is that perhaps, 50 basis point cut was a surprise to the market, but the other factors are actually saying interest rates are not going to come back to normal as quickly as we thought. So that might be why we're seeing some of this counter flow. It's actually only 10,000 contracts net long right now, which is pretty wild. Well, I don't think it's a nothing burger. I think it's actually a huge deal. It's just, what does it mean for you in your trades at the moment right now? It's unclear. Right? You're not seeing the flows coming in. The press conference is going to be a big deal. Like, we could see huge moves during the press conference. According to a News/Ipsos survey, a majority of Americans support the mass deportation of undocumented immigrants. I would not have expected that result. I would think that it would maybe be like 40% of Americans, not a majority. Okay, a little bit of a rush up there. Kind of interesting. FOMC's new summary of economic projections is just about the closest thing to mission accomplished manner you can imagine them unfurling. 2% inflation going forward with no slowdown in economic growth and the unemployment rate staying low and falling. Wonder why it just all of a sudden, just like that, turned back on and they moved up. Liquidity's still light. Micros, well, liquidity in micros is actually a little bit better than I thought it would be. But like the overall liquidity is bad, but the spread is at times 1 or 2 ticks. So does anyone know of a way for retailers to get access to credit card consumer data and spending trends? No. I think there are places you can buy that stuff though. I've never done it. Well, that one worked really, really well. I'm super happy about it. Okay, I can just relax now. You gonna stop me out down at 20.5? I dare you. I dare you. Been messing around with the headphones right now. My head doesn't hurt. Feels fine right now. Apparently, I just need to make a headphone review YouTube channel. How many pairs have I been through? Well, so from the stream, I started out with a pair of HDJ 2000s, and then those broke. I don't remember what happened to those, but those broke. And then I got the that's when I got these other ones. I can't remember what they're called. But it was like, it was an HDJs, but they were kind of, they had a profile that was more for producing, so it had a little bit more of an even profile. DJ headphones have a profile that really accentuates like the 100 to 200 hertz range, so that you can really hear that kick. So, the thing is I don't really DJ anymore, and the primary use for the headphones is talking to you guys, talking on stream and stuff. Because if I don't really need my headphones on, I can just play off of my speakers, and that sounds better. So if I really want to listen to music, I should just listen with my studio monitors. But you know, the family doesn't want to hear that all day. Sometimes it's late at night, etc. And so that's when having a pair of headphones that are good for listening and acceptable for production is useful, and so that's why I went to those ones that were kind of more producer style thing. So those lasted me not as long, 1 or 2 years. Those are just trash. So then I got the III headphones, and those ones, the ear cups are too small. And then I got these, the Bayer Dynamic. What is it? What is the DT177X? And there's a lot of things that I like about these. There's a lot of things that I like about these. But they seem to be heavy. That seems to create hot spots on my head. So I've been spending a little bit of time. I was just reading through this thing. This looks like 3D printed to me, but very dynamic comfort strap. So it creates kind of the strap that I had on those other headphones that I didn't have any problems with those. And it's ventilated. So yeah. Does that work better for me? Maybe, I think so. I think that will probably work better. So I could do that for $20, and then maybe that would resolve the problem with it being feeling like too heavy and on top of my head and everything. Just distribute the weight over a larger area. Okay, now I got a meeting in 10 minutes, so don't let me forget. Let's make sure here. So if yeah, okay. I don't know if you heard that. Yeah. So you'll be able to hear the press conference, but I'm going to be doing me and you won't see or hear me. Anyways, so that's like, but I've been thinking like maybe I should just return these and get like the cheapo Sonys that are only like $100. Like they'd be more comfortable. And I'm kind of starting to think, well, the comfort maybe actually matters more. I'm gonna wear them so much. But on the other hand, like these are really built, I think that maybe with some modification, I can get these more comfortable than other things. So we'll see. You can see here, like that. I'm clearly obsessed. I'm clearly having one of those ADHD hyper interest binges because I got all these things. So here's a microfiber head strap. That looks interesting to me. Doesn't really show the underside of it very well, but that looks like that would be more comfortable. And there's the comfort strap. These are some Sonys that kind of sound like they have the sort of audio profile that I'm looking for, but are cheaper, $249. I don't think these would be as durable though. These are the cheap Sonys. I don't need that one anymore. And then I'm just going through like all of these posts, trying to find. Here's this one over here. Here's a Picani. They have a suede leather headband. I don't like the way that one looks though. It kind of looks cheap. Even though I know they have quality leather. You can just switch the headbands between their different models. That's interesting. Oh, here somebody made a post. Comfort modded. Oh, he made his own comfort strap with leather that he had lying around. Sony MDR V6, but you've had to change the phone before. Yeah, that's, is that this? Oh. No, you have MDR V6. Is that different? Oh, those are much more expensive. But see, like, again, I like, I don't want to spend that much. I don't want, I've had problems with that kind of, the tilt mechanism. Like, they come out and they break and they don't work. Okay. It looks like they're coming back a little bit. I'm gonna read the reviews on those ones. That same website. So we got like 4 options. I don't know what I'm gonna do. Got like, let's see here. Comfort strap. The cover. There's these nuggets, these little like leather things you just put in different spots. Then there's 2 alternative Sony options that I got. So, too many choices. But I'm not going to do anything for a while. I think I'm going to give this like a week. (10/9) on dots for 4 cuts in 2024. It was close call, given that they cut 50 basis points today. I suspect there are trade-offs, which we'll hear about in the Q&A. This looks and smells like an insurance cut rather than a confirmation that there are more 50 basis point cuts happening. Watch out for the hawkish pushback in the Q&A. What that really means is whatever he says, we're going to find a way to interpret it hawkishly and try and push it our way. Often how that plays out. Okay, so I am going to mute myself and all of that. You guys watch the meeting, and I will maybe be back later. I got a couple of things to do, okay?
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state. Inflation has eased substantially from a peak of 7% to an estimated 2.2% as of August. We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. Today, the Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by a half percentage point. This decision reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in a context of moderate growth and inflation moving sustainably down to 2%. We also decided to continue to reduce our securities holdings. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.2% in the first half of the year, and available data point to a roughly similar pace of growth this quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has picked up from its anemic pace last year. In the housing sector, investment fell back in the second quarter after rising strongly in the first. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to remain solid, with a median projection of 2% over the next few years. In the labor market, conditions have continued to cool. Payroll job gains averaged 116,000 per month over the past 3 months, a notable step down from the pace seen earlier in the year. The unemployment rate has moved up but remains low at 4.2%. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of elevated inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year, 0.4 higher than projected in June. Inflation has eased notably over the past 2 years, but remains above our longer-run goal of 2%. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.2% over the 12 months ending in August, and that excluding the volatile food and energy categories, core PCE prices rose 2.7%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.3% this year and 2.1% next year, somewhat lower than projected in June. Thereafter, the median projection is 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. For much of the past 3 years, inflation ran well above our 2% goal, and labor market conditions were extremely tight. Our primary focus had been on bringing down inflation, and appropriately so. We are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our restrictive monetary policy has helped restore the balance between aggregate supply and demand, easing inflationary pressures and ensuring that inflation expectations remain well anchored. Our patient approach over the past year has paid dividends. Inflation is now much closer to our objective, and we have gained greater confidence that inflation is moving sustainably toward 2%. As inflation has declined and the labor market has cooled, the upside risks to inflation have diminished and the downside risks to employment have increased. We now see the risks to achieving our employment and inflation goals as roughly in balance. And we are attentive to the risks to both sides of our dual mandate. In light of the progress on inflation and the balance of risks, at today's meeting, the committee decided to lower the target range for the federal funds rate by a half percentage point to 4.75% to 5%. This recalibration of our policy stance will help maintain the strength of the economy and the labor market, and will continue to enable further progress on inflation as we begin the process of moving toward a more neutral stance. We are not on any preset course. We will continue to make our decisions meeting by meeting. We know that reducing policy restraint too quickly could hinder progress on inflation. At the same time, reducing restraint too slowly could unduly weaken economic activity and employment. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 4.4% at the end of this year and 3.4% at the end of 2025. These median projections are lower than in June, consistent with the projections for lower inflation and higher unemployment, as well as the changed balance of risks. These projections, however, are not a committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation back down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Steve Leisman, CNBC. Thank you, Mr. Chairman, for taking our questions. In July, you said you weren't necessarily thinking about a 50. You didn't want to be specific, but you said you were thinking about a 50. The inflation data last week came out a little firmer than expected. Retail was strong, third quarter GDP running 3%. So what changed that made the committee go 50, and how do you respond to the concerns that perhaps it shows the Fed is more concerned about the labor market? And I guess, should we expect more 50s in the months ahead? And based on what should we make that call? Thank you.
So, okay, a lot of questions in there. Let me jump in. Since the last meeting, we have had a lot of data come in. We've had the two employment reports, July and August. We've also had two inflation reports, including one that came in during blackout. We had the QCEW report, which suggests that suggests that the payroll report numbers that we're getting may be artificially high and will be revised down. You know that. We've also seen anecdotal data like the Beige Book. And so we took all of those and we went into blackout and we thought about what to do, and we concluded that this was the right thing for the economy, for the people that we serve, and that's how we made our decision. So that's one question. What was the second and third?
How do we make the sorry, thank you, sir. How do we figure out in the months ahead, is there another 25 or 50 coming in? Based on what shall we make that call? Thank you.
Sure. So a couple things. A good place to start is the SEP, but let me start with what I said, which was that we're going to be making decisions meeting by meeting based on the incoming data, the evolving outlook, the balance of risks. If you look at the SEP, you'll see that it's a process of recalibrating our policy stance away from where we had it a year ago when inflation was high and unemployment low, to a place that's more appropriate given where we are now and where we expect to be. And that process will take place over time. There's nothing in the SEP that suggests the committee is in a rush to get this done. This process evolves over time. Of course, that's a projection. That's a baseline projection. We know, as I mentioned in my remarks, that the actual things that we do will depend on the way the economy evolves. We can go quicker if that's appropriate. We can go slower if that's appropriate. We can pause if that's appropriate. But that's what we are contemplating. Again, I would point you to the SEP as just an assessment of where of what the committee is thinking today, what the individual members, rather, of the committee are thinking today, assuming that their particular forecasts are realized.
Go to Chris.
Hi, Chris Rugaber at Associated Press. Thank you. The projections show that the Fed officials expect the Fed funds rate to still be above their estimate of long-run neutral by the end of next year. So does that suggest you see rates as restrictive for that entire period? Does that threaten the weakening of the job market that you said you'd like to avoid? Or does it suggest that maybe people see the short-run neutral as a little bit higher? Thank you.
I think the way I would really characterize it is this. I think people write down their estimate, individuals do. I think every single person on the committee, if you ask them what's your level of certainty around that, and they would say there's a wide range where that could fall. So I think we don't know. There are model-based approaches and empirically based approaches that estimate what the neutral rate will be at any given time. But realistically, we know it by its works. So that leaves us in a place where we expect, in the base case, to be continuing to remove restriction, and we'll be looking at the way the economy reacts to that, and that'll be guiding us in our thinking about the question that we're asking at every meeting, which is our policy stance the appropriate one? We know, if you go back, we know that the policy stance we adopted in July of 2023 came at a time when unemployment was 3.5% and inflation was 4.2%. Today, unemployment is up to 4.2%, inflation's down to a few tenths above 2. So we know that it is time to recalibrate our policy to something that is more appropriate given the progress on inflation and on employment, moving to a more sustainable level. So that the balance of risks are now even. And this is the beginning of that process. I mentioned the direction of which is toward a sense of neutral. And we'll move as fast or as slow as we think is appropriate in real time. But what you have is our individual accumulation of individual estimates of what that will be in the base case.
Howard.
Howard Schneider with Reuters. How close was this in terms of the decision? You do have the first dissent by a governor since 2005, I think. Was the weight clearly in favor of a 50, or was this a very close decision?
I think we had a good discussion. If you go back, I talked about this at Jackson Hole, but I didn't address the question of the size of the cut, left it open, and I think we left it open going into blackout. And so there was a lot of discussion back and forth, good diversity of opinion, excellent discussion today. I think there was also broad support for the decision that the committee voted on. So I would add, though, look at the SEP. All 19 of the participants wrote down multiple cuts this year, all 19. That's a big change from June, right? 7 of them wrote down 3 or more, 17 of the 19 wrote down 3 or more cuts, and 10 of the 19 wrote down 4 or more cuts. So, there is a dissent, and there's a range of views, but there's actually a lot of common ground as well.
Follow up to that, now that this is in the books, can you give us some guidance, as sort of follow up to Steve, on the pacing here? Would you expect this to be running every other meeting once we get into next year? Yeah,
we're going to take it meeting by meeting. As I mentioned, there's no sense that the committee feels it's in a rush to do this. We made a good, strong start to this, and that's really, frankly, a sign of our confidence that inflation is coming down toward 2% on a sustainable basis. That gives us the ability. We can, make a good, strong start, but. And I'm very pleased that we did. To me, the logic of this, both from an economic standpoint and also from a risk management standpoint, was clear. But I think we're going to go carefully, meeting by meeting, and make our decisions as we go.
Gina.
Hi, Chair Powell. Gina Smilik, the New York Times. Thanks for taking our questions. You and your colleagues in your economic projections today see the unemployment rate climbing to 4.4% and staying there. Obviously, historically, when the unemployment rate climbs that much over a relatively short period of time, it doesn't typically just stop. It continues increasing. And so I wonder if you can walk us through why you see the labor market stabilizing, sort of what's the mechanism there, and what do you see as the risks?
So, again, the labor market is actually in a solid condition. And our intention with our policy move today is to keep it there. You can say that about the whole economy. The U.S. economy is in good shape. It's growing at a solid pace. Inflation is coming down. The labor market is in a strong pace. We want to keep it there. That's what we're doing.
Sorry, Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, does today's action constitute a catch-up in action given recent substantial revisions to the employment data? Or is this larger than typical rate cut a function of the elevated nominal level of the policy rate such that an accelerated cadence could be expected to continue?
Okay. Multiple questions in there. But so I would say we don't think we're behind. We do not think we think this is timely. But I think you can take this as a sign of our commitment not to get behind. So it's a strong move. Sorry, your other question was?
Well, is this about what happened in the employment data between this meeting and the last meeting, or is this about the level of the funds rate, the high nominal level of the funds rate relative to what might be expected if you're trying to maintain equilibrium?
So I think it's about, we come into this with a policy position that was put in place, as you know, I mentioned in July of 2023, which was a time of high inflation and very low unemployment. We've been very patient about reducing the policy rate. We've waited. Other central banks around the world have cut, many of them several times. We've waited, and I think that patience has really paid dividends in the form of our confidence that inflation is moving sustainably down to 2%. So I think that is what enables us to take this strong move today. I do not think that anyone should look at this and say, oh, this is the new pace. You have to think about it in terms of the base case. Of course, what happens will happen. So in the base case, what you see is, look at the SEP. You see cuts moving along. The sense of this is we're recalibrating policy down over time to a more neutral level. And we're moving at the pace that we think is appropriate given developments in the economy in the base case. The economy can develop in a way that would cause us to go faster or slower, but that's what the base case says.
And if I could follow up on the balance sheet. In 2019, when you did the mid-cycle adjustment, you ceased the balance sheet runoff. With a larger cut today, should there be any signal inferred about how the committee would approach end state on the balance sheet policy?
So in the current situation, reserves have really been stable. They haven't come down. So reserves are still abundant and expected to remain so for some time. As you know, the shrinkage in our balance sheet has really come out of the overnight RRP. So I think what that tells you is we're not thinking about stopping runoff because of this at all. We know that these two things can happen side by side. In a sense, they're both a form of normalization. And so for a time, you can have the balance sheet shrinking, but also be cutting rates.
Colby.
Thank you. Colby Smith with the Financial Times. Just following up on Gina's question on rising unemployment, is it your view that this is just a function of a normalizing labor market amid improved supply? Or is there anything to suggest that something more concerning perhaps is taking place here, given that other metrics of labor demand have softened too? And I guess in direct follow-up to Gina is, why should we not expect a further deterioration in labor market conditions if policy is still restrictive?
So I think what we're seeing is clearly labor market conditions have cooled off by any measure, as I talked about in Jackson Hole. And but they're still at a level. The level of those conditions is actually pretty close to what I would call maximum employment. So you're close to mandate, maybe at mandate on that. So what's driving it? Clearly, payroll job creation has moved down over the last few months, and this bears watching. Meant by many other measures, the labor market has returned to or below 2019 levels, which was a very good, strong labor market, but this is more sort of 2018-17. So the labor market bears close watching, and we'll be giving it that. But ultimately, we believe, with an appropriate recalibration of our policy, that we can continue to see the economy growing, and that will support the labor market. In the meantime, if you look at the growth in economic activity data, the retail sales data that we just got, second quarter GDP, all of this indicates an economy that is still growing at a solid pace. So that should also support the labor market over time. So, but again, it bears watching, and we're watching.
And just on the point about starting to see rising layoffs, if that were to happen, wouldn't the committee already be too late in terms of avoiding a recession?
So our plan, of course, has been to begin to recalibrate. And as you know, we're not seeing rising claims. We're not seeing rising layoffs. We're not seeing that, and we're not hearing that from companies that that's something that's getting ready to happen. So we're not waiting for that, because there is thinking that the time to support the labor market is when it's strong, and not when you begin to see the layoffs. There's some lore on that. So that's the situation we're in. We have, in fact, begun the cutting cycle now, and we'll be watching, and that'll be one of the factors that we consider. Of course, we're going to look at the totality of the data as we make these decisions meeting by meeting.
Michael McKee with Bloomberg TV and Radio. To follow up on that, what would constitute for you and the committee a deterioration in the labor market? You're pricing in basically by the end of next year 200 basis points of cuts just to maintain a higher unemployment rate. Would you be moving to a more preemptive monetary policy style rather than, as you did with inflation, waiting until the data gave you a signal?
No, we're going to be watching all of the data, right? So if, as I mentioned in my remarks, if the labor market were to slow unexpectedly, then we have the ability to react to that by cutting faster. We're also going to be looking at our other mandate, though. We have greater confidence now that inflation is moving down to 2%, but at the same time, our plan is that we will be at 2%, over time. So. And policy, we think, is still restrictive, so that should still be happening.
I'm just curious as to how sensitive you'll be to the labor market, since you forecast we are going to see higher unemployment, and it is going to take a significant amount of monetary easing to just maintain it.
So, what I would say is we don't think we need to see further loosening in labor market conditions to get inflation down to 2%. But we have a dual mandate, and I think you can take this whole action as take a step back. What have we been trying to achieve? We're trying to achieve a situation where we restore price stability without the kind of painful increase in unemployment that has come sometimes with disinflation. That's what we're trying to do. And I think you can take today's action as a sign of our strong commitment to achieve that goal.
Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. You're describing this view that you don't think you're behind when it comes to the job market. Can you walk us through the specific data points that you found to be most helpful in the discussions at this meeting? You've mentioned a couple, but would you be able to walk us through what that dashboard told you as far as what you know about the job market now?
Sure. So we'll start with unemployment, which is the single most important one probably. You're at 4.2%. That's, I know that's higher than we were used to seeing numbers in the mid and even below mid threes last year. But if you look back over the sweep of the years, that's a very healthy unemployment rate. And anything in the low fours is a good labor market. So that's one thing. Participation is at high levels. It's, we're right adjusted for demographics, for aging. Participation's at pretty high levels. That's a good thing. Wages are still a bit above what would be, their wage increases rather, are still just a bit above where they would be over the very longer term to be consistent with 2% inflation, but they're very much coming down to what that sustainable level is, so we feel good about that. Vacancies over, per unemployed is back to what is still a very strong level. It's not as high as it was. That number reached 2 to 1, 2 vacancies for every unemployed person, as measured. It's now below around 1, but that's still a very good number, I would say. Quits have come back down to normal levels. I mean, that could go on and on. There are many, many employment indicators. What do they say? They say this is still a solid labor market. The question isn't the level. The question is that there has been change, particularly over the last few months. And so what we say is, as the risks, the upside risks to inflation have really come down, the downside risks to employment have increased. And because we have been patient and held our fire on cutting while inflation has come down, I think we're now in a very good position to manage the risks to both of our goals.
And what do you expect to learn between now and November that will help inform the scale of the cut at the next meeting?
More data, the usual. Don't look for anything else. We'll see another labor report. We'll see another jobs report. I think we get a second jobs report on the day of the meeting, I think. On the Friday before the meeting. And inflation data. We'll get all this data. We'll be watching. It's always a question of look at the incoming data and ask what are the implications.
So I got a second meeting here. I got a little bit of a break.
Risks.
No clue what Powell has said here, but it does look like maybe he has pushed back because the market has come back to almost unchanged.
That's what it is
from before the news in the Treasury. So be careful until he's done talking.
Hi, Chair Powell. Neil Irwin with Axios.
And tomorrow
we've been
could
running
be
a little above
some
100,000 jobs a month on payroll the last 3 months.
action.
Do you view that level of job creation as worrying or alarming, or would you be
I don't know what TLA is talking about.
Stick at that
Always
level.
sounds like it's
And relatedly, one of the welcome trends of the last couple of years has been labor market steam coming out through job openings falling rather
something
than job
Powell was
losses.
talking
Do you think that trend has further to run, or do you see risk that further labor market cooling will have to come through job losses?
I didn't like that.
On the job creation, it depends on the inflows, right? So if you're having millions of people come into the labor force, and you're creating 100,000 jobs,
You're gonna have to go back
you're going to
and
see
watch
unemployment
the
go
meeting
up.
afterwards,
So
I guess.
it really depends on what's the trend underlying the volatility of people coming into the country. We understand there's been quite an influx across the borders, and that has actually been one of the things that's allowed unemployment rate to rise. And the other thing is just the slower hiring rate, which is something we also watch carefully. So it does depend on what's happening on the supply side. And on the beverage curve question, yes. So we all felt on the committee, not all, but I think everyone on the committee felt that job openings were so elevated that they could fall
Now,
a
I'm
long
kinda
way
looking at
before
this.
you hit the part of the curve where job openings turned into higher unemployment.
It looks
job
to
loss.
me like
And,
if I had been watching this,
yes,
that
I
I would
mean,
have
I think
gotten
we
out
are-
already.
It's hard to know that you can't know these things with great precision, but certainly it appears that we're very close to that point, if not at it, so that further declines in job openings
Because
will
the
translate
deltas
more
look
directly
around
into unemployment. But it's been a great ride down. I mean, we've seen a lot of tightness come out of the labor market in that form without it resulting in lower employment.
Thanks, Chair Powell. Edward Lawrence, Fox Business. So we've heard some speculation that you may be going with the federal funds rate to 3.5%, maybe under 4%. And there's basically an entire generation that has experienced zero or near zero federal funds rate. Now some think we're heading in that direction again. What's the likelihood that cheap money is now the norm?
So this is a question, and you mean after we get through all of this? It's just a great question that we can only speculate about. Intuitively, many people anyway would say we're probably not going back to that era where there were trillions of dollars of sovereign bonds trading at negative rates, long-term bonds trading at negative rates. And it looked like the neutral rate might even be negative. So people were issuing debt at negative rates. It seems that's so far away now. My own sense is that we're not going back to that. But honestly, we're going to find out. But it feels to me, and that the neutral rate is probably significantly higher than it was back then. How high is it? I just don't think we know. It's, again, we only know it by its works.
And one more. How do you respond to the criticism that will likely come that a deeper rate cut now before the election has some political motivations?
Yeah, so, this is my 4th presidential election at the Fed, and, it's always the same. We're always going into this meeting in particular and asking what's the right thing to do for the people we serve. And we do that, and we make a decision as a group, and then we announce it. And that's always what it is. It's never about anything else. Nothing else is discussed. And I would also point out that the things that we do really affect economic conditions for the most part with a lag. So nonetheless, this is what we do. Our job is to support the economy on behalf of the American people. And if we get it right, this will benefit the American people significantly. So this really concentrates the mind, and it's something we all take very, very seriously. We don't put up any other filters. I think if you start doing that, I don't know where you stop. And so we just don't do that.
Jolene.
Thank you, Chair Powell. I'm Jolene Kent with CBS News. My first question is, very simply, what message are you trying to send American consumers, the American people, with this unusually large rate cut?
I would just say that, the U.S. economy is in a good place, and our decision today is designed to keep it there. More specifically, the economy is growing at a solid pace. Inflation is coming down closer to our 2% objective over time. And the labor market is still in solid shape. So our intention is really to maintain the strength that we currently see in the U.S. economy. And we'll do that by returning rates from their high level, which has really been, the purpose of which has been to get inflation under control. We're going to move those down over time to a more normal level over time.
Just a quick follow-up to that. Listening to you talk about inflation moving meaningfully down to 2%, is the Federal Reserve effectively declaring a decisive victory over inflation and rising prices?
No, we're not. So inflation, what we say is we want inflation, the goal is to have inflation move down to 2% on a sustainable basis. And, we're not really, we're close, but we're not really at 2%. And I think we're going to want to see it be, around 2% and close to 2% for some time. But we're certainly not doing, we're not saying mission accomplished or anything like that. But I have to say, though, we're encouraged by the progress that we have made.
Hi, Katerina Saraiva with Bloomberg News. I just would love to know kind of how the committee is thinking about the persistence we've seen in housing inflation. Do you think you can return to 2% with housing inflation where it is? Yeah.
So housing inflation is the one piece that is kind of dragging a bit, if I can say. We know that market rents are doing what we would want them to do, which is to be moving up at relatively low levels. But they're not rolling over. The leases that are rolling over are not coming down as much, and OER is coming in high. So, it's been slower than we expected. I think we now understand that it's going to take some time for those lower market rents to get into this. But, the direction of travel is clear, and as long as market rents remain, relatively low inflation over time, that will show up. Just the time it's taking now, several years rather than just 1 or 2 cycles of annual lease renewals. So I think we understand that now, but I don't think the outcome is in doubt. Again, as long as market rents remain under control, the outcome is not in doubt. So I would say it's the rest of the portfolio, or of the elements that go into core PCE inflation have behaved pretty well. They all have some volatility. We will get down to 2% inflation, I believe, and I believe that ultimately we'll get what we need to get out of the housing services piece too.
Some of your colleagues have expressed concern that with starting to cut rates, you could reignite demand in housing and see prices go up even more. What's the likelihood of that, and how would you react to that?
The housing market, it's hard to game that out. The housing market is in part frozen because of lock-in with low rates. People don't want to sell their home, so because they have a very low mortgage, it'd be quite expensive to refinance. As rates come down, people will start to move more, and that's probably beginning to happen already. But remember, when that happens, you've got a seller, but you've also got a new buyer in many cases. So it's not, obvious how much additional demand that would make. I mean, the real issue with housing is that we have had and are on track to continue to have not enough housing. And so it's going to be challenging. It's hard to to zone lots that are in places where people want to live. It's all of the aspects of housing are more and more difficult. And where are we going to get the supply? And this is not something that the Fed can really fix. But I think as we normalize rates, you'll see the housing market normalize. And I mean, ultimately, by getting inflation broadly down and getting those rates normalized and getting the housing cycle normalized, that's the best thing we can do for householders. And then the supply question will have to be dealt with by the market and also by government.
Victoria.
Hi, Victoria Guido with Politico. Just following up on some of the labor market talk earlier, monetary policy operates with long and variable lags, and I'm wondering how much you see being able to keep the unemployment rate from raising too much comes from the fact that you're starting to act now, and that's going to give people more room to run versus just the labor market is strong. And then also, if I could, following up on Nick's question, do you see today's 50 basis point move as partially a response to the fact that you didn't cut in July, and that sort of gets you to the same place?
So you're right about lags, but I would just point to the overall economy. You have an economy that is growing at a solid pace. If you look at forecasters or talk to companies, they'll say that they think 2025 should be a good year too. So there's no sense that the U.S. economy is basically fine. If you talk to market participants, I mean, business people who are actually out there doing business. So I think, I think our move is timely. I do, and as I said, you can see our 50 basis point move as a commitment to make sure that we don't fall behind. So you're really asking about your second question. You're asking about July, and I guess if you ask, if we'd gotten the July report before the meeting, would we have cut? We might well have. We didn't make that decision, but we might well have. I think that's not, that doesn't really answer the question that we ask ourselves, which is let's look, at this meeting we're looking back to the July employment report, the August employment report, the two CPI reports, one of which came, of course, during blackout, and all of the other things that I mentioned. We're looking at all of those things, and we're asking ourselves, what's the policy stance we need to move to? It's clear that we literally everyone on the committee agreed that it's time to move. It's just how fast do you go, and what do you think about the path forward? So this decision we made today had broad support on the committee, and I've discussed the path ahead.
Elizabeth.
Thank you, Chair Powell. Elizabeth Schulze with ABC News. Mortgage rates have already been dropping in anticipation of this announcement. How much more should borrowers expect those rates to drop over the next year?
Very hard for me to say. That's from our standpoint. I can't really speak to mortgage rates. I will say, that'll depend on how the economy evolves. Our intention, though, is we think that our policy was appropriately restrictive. We think that it's time to begin the process of recalibrating it to a level that's more neutral rather than restrictive. We expect that process to take some time, as you can see in the projections that we released today. And if things work out according to that forecast, other rates in the economy will come down as well. However, the rate at which those things happen will really depend on how the economy performs. We can't look a year ahead and know what the economy is going to be doing.
What's your message to households who are frustrated that home prices have still stayed so high as rates have been high? What do you say to those households?
Well, what I can say to the public is that we had we had a burst of inflation. Many other countries around the world had a similar burst of inflation. And when that happens, part of the answer is that we raise interest rates in order to cool the economy off, in order to reduce inflationary pressures. It's not something that people experience as pleasant, but at the end, what you get is low inflation restored, price stability restored. And a good definition of price stability is that people in their daily decisions, they're not thinking about inflation anymore. That's where everyone wants to be, is back to what's inflation. You know, we just keep it low, keep it stable. We're restoring that. So what we're going through now really, it restores, it will benefit people over a long period of time. Price stability benefits everybody over a long period of time just by virtue of the fact that they don't have to deal with inflation. So that's what's been going on, and I think we've made real progress. We don't tell people how to think about the economy, of course, and of course people are experiencing high prices as opposed to high inflation, and we understand that's painful.
Greg.
Hi, Chair Powell. Greg Robb from MarketWatch.com. I was wondering if you could go through, you said just at the beginning that coming into the blackout, there was like an open thought of 25 or 50. You know, the Fed could move either 25 or 50. I would sort of argue that when we had those two last speeches by Governor Waller and New York Fed President John Williams, that they were sort of saying that maybe a gradual approach was going to win the day. I mean, I sort of want to ask a 7-part question about this, but I mean, could you talk, would you have cut rates by 50 basis points if the market had been pricing in like low odds of a 50-point move like they were last Wednesday? You know, after the CPI number came out, it was a really small probability of a 50-point cut. Does that play in your consideration at all? Just talk a little bit about that. Thank you.
We're always going to try to do what we think is the right thing for the economy at that time. That's what we'll do. And that's what we did today.
Simon.
Thank you, Chair Powell. Simon Rabinovich with The Economist. You've mentioned how closely you're watching the labor market, but you also noted that payroll numbers have been a little bit less reliable lately because of the big downward revisions. Does that put your focus overwhelmingly on the unemployment rate? And given the SEP projection of 4.4 basically being the peak in the cycle, would going above that be the kind of thing that would trigger another 50 basis point cut?
So we will continue to look at that broad array of labor market data, including the payroll numbers. We're not discarding those. I mean, we'll certainly look at those, but we will mentally tend to adjust them based on the QCEW adjustment, which you referred to. There isn't a bright line. It will be, the unemployment rate's very important, of course, but there isn't a single statistic or a single bright line over which that might move that would dictate one thing or another. We'll look at each meeting, we'll look at all the data on inflation, economic activity, and the labor market, and we'll make decisions about is our policy stance where it needs to be to foster over the medium term our mandate goals. Yeah, so I can't say we have a bright line in mind.
Matt Egan.
Thanks, Chair Powell. Matt Egan from CNN. I know that you discussed earlier how the Fed does whatever the right thing is and nothing else factors in. But in general, can you talk about whether or not you believe a sitting U.S. president should have a say in Fed decisions on interest rates? Because that's something that former President Trump, who obviously appointed you, has previously suggested. And I know the Fed is designed to be independent, but why? Can you tell the public why you view that so important?
Sure. So countries that are democracies around the world, countries that are sort of like the United States, all have what are called independent central banks. And the reason is that people have found over time that insulating the central bank from direct control by political authorities avoids making monetary policy in a way that favors maybe people who are in office as opposed to people who are not in office. So that's the idea, is that, and I think the data are clear that countries that have independent central banks, they get lower inflation. And so we do our work to serve all Americans. We're not serving any politician, any political figure, any cause, any issue, nothing. It's just maximum employment and price stability on behalf of all Americans. And that's how the other central banks are set up too. It's a good institutional arrangement, which has been good for the public. And I hope and strongly believe that it will, continue.
Kyle.
Kyle Campbell for American Banker. Thanks for taking the questions, Chair Powell. A couple regulatory developments in the past week that I want to ask you about. First, last week, Vice Chair for Supervision, Michael Barr, outlined his views for the changes to the Basel III Endgame. I'm wondering if you are in alignment with him on what those changes should be, if those have support on the board in a broad way that you're looking for, and if you think the other agencies are also fully on board with that approach. And then yesterday, other banking regulators.
You know what? Hold the second question.
Okay, sure.
Let me we'll give you the second question. So, the answer to your question is that yes, those changes were negotiated between the agencies with my support and with my involvement, with the idea that we were going to repropose the changes that Vice Chair Barr talked about, and then take comment on them. So yes, that is, that's happening with my support.
Is there a date for that?
That's not a final proposal, though. You understand? We're putting them out for comment. We're going to take comment and make appropriate changes. We don't have a calendar date for that. And as for the other agencies, the idea is that we're all moving together. We're not moving separately. So that I don't know exactly where that is, but the idea is that we will move as a group to put this again out for comment, and then it'll come. The comments will come back 60 days later, and we'll dive into them, and we'll try to bring this to a conclusion sometime in the first half of next year.
Right. And then yesterday there were merger reform finalizations from the other bank regulators. Well, what does the Fed have to do to align itself on merger?
I would bounce that question to Vice Chair Barr. It's a good question, but I don't have that today. Thanks.
Okay, Jennifer for the last question.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said earlier that the decision today reflects with appropriate recalibration strength in the labor market that can be maintained in the context of moderate growth. Even though the policy statement says you view the risks to inflation and job growth as roughly balanced. Given what you've said, though, today, I'm curious, are you more worried about the job market and growth than inflation? Are they not roughly balanced?
No, I think, and we think they are now roughly balanced. So if you go back for a long time, the risks were on inflation. We had a historically tight labor market, historically tight. There was a severe labor shortage, so very hot labor market, and we had inflation way above target. So, that said to us, concentrate on inflation, and we did for a while, and we kept at that. The stance that we put in place 14 months ago was a stance that was focused on bringing down inflation. Part of bringing down inflation, though, is cooling off the economy and a little bit cooling off the labor market. You now have a cooler labor market in part because of our activities. So what that tells you is it's time to change our stance. So we did that. The sense of the change in the stance is that we're recalibrating our policy over time to a stance that will be more neutral. And today I think we made a good, strong start on that. I think it was the right decision, and I think it should send a signal that that we're committed to coming up with a good outcome here.
Is the economy more vulnerable to a shock now that could tip it into recession?
I don't think so. I don't. As I look. Well, let me look at it this way. I don't see anything in the economy right now that suggests that the likelihood of a recession, of a downturn, is elevated. Okay, I don't see that. You see growth at a solid rate. you see inflation coming down, and you see a labor market that's still at very solid levels. So I don't really see that, no. Thank you.
Thank you.
All right, well, it looks like the market was a little unhappy with the press conference, but nothing too crazy done. And we will see here in a few seconds the closing auction. Let's see a huge flurry of activity. And then again, I'm sorry, you know, when we're doing these things during the day, I just have it running on the other screen and I'm doing other stuff. Actually, a lot of meetings today. So not really a whole lot of time to chat or analyze it. Sometimes when I'm on my lunch, I can do stuff, but not today. So we'll just have to talk about it tomorrow morning. But it looks like that's all there is. And I'm surprised to see us down all the way down at 29 now. So that's super interesting. But anyways, now that that's a close, I think that there's time to close this down. Thanks to you guys, anybody that's still there. And I'll see you guys in the morning, all right?